Chances are, if you're looking to buy or sell a home in 2022, you're worried about interest rates. You're probably following interest rates on a daily, maybe a weekly basis, because if interest rates rise, it could ultimately affect how much you pay on the home, but could end up bringing home prices down, which is a good thing. But at the same time, if we get inflation rising and home prices rising at the same time, along with interest rates, it could be a catastrophe. So what we're going to talk about today is what we've seen historically with regards to interest rates over 4 decades. We're going to go all the way back to the 1970s and talk about what the Fed chairman did back then, how it affected interest rates, how it affected inflation, and then we're going to move into the 80s, the 90s, and then we're going to talk about today. We're going to talk about what's happening at the moment, the expectations for 2022 with regards to the Fed tapering mortgage-backed securities, tapering mortgage bond purchases, and how that is likely going to affect interest rates, which could tell us the direction of home prices at the end of the day. Now, if you've been watching my channel for any period of time, you know I'm not a doom and gloomer. I'm not a housing crash guy. And I think the information that we're going to talk about today supports that, but there's also a couple of things that are kind of left out there that are to be determined, if you will. So I think it's important, if you're considering buying a home or selling a home in 2022, that you watch this video to get an idea of what could happen, assuming the Fed actually follows through with their policy. My name is Jeb Smith. I'm a real estate broker here in Southern California. My channel is all about real estate, guiding you through that process, whether it's helping you out with interest rates, home prices, or just what's happening in the market. So do me a favor, if you find any value in this content at all, hit the thumbs up, smash it, punch it, whatever it is, and share it with a friend. Maybe subscribe to the channel if you want more information like this. Now, one of the most common comments I get on my videos is that history repeats itself. Everybody wants to talk about home prices going down. Everybody wants to talk about, a crash, if you will. So let's talk about history repeating itself. We're going to go back 4 decades, as I mentioned, and talk about what happened in the 70s. But before we do that, let's take a minute here and talk about what the Fed is planning on doing in 2022, what they've laid out there so far. So what we know so far is that they're planning on tapering mortgage bond purchases, mortgage-backed security purchases through March, right? They should end in March, at which point they're going to start to raise the Fed funds rate. Now, there's been talks of raising the Fed funds rate anywhere between 2 and 4 times. Depending on who you talk to, you're going to get a different idea, a different answer of how many times they're going to raise the Fed funds rate, but the average is 3 times. So the Fed is expected to raise the Fed funds rate 3 times this year, which ultimately isn't interest rates. Keep that in mind, right? The Fed funds rate is the rate that banks borrow money from one another. It is not interest rates. So just because the Fed raises the Fed funds rate doesn't necessarily mean interest rates are going to follow suit. And that's what we're going to talk about a little bit here as we go back in history and talk about a couple of different Fed chairmen over the course of years. Now, as we're talking about this information, I want to be clear, this is not my research. I actually received this information from one of Barry Habib's videos. If you're not familiar with Barry, he's essentially a guru on everything with regards to interest rates, mortgage-backed securities. He is the man when it comes to forecasting the direction of interest rates. So I want to be clear, this information came from him, not from me, but let's take a minute here and talk about it. So let's go back to the 1970s. 1970s, the Fed chairman at the time was Arthur Burns. And now under his watch, inflation went from 7% in 1978 to 14% in 1980. He thought inflation was transitory, a lot like what we're experiencing now, and he let it run red hot. And interest rates went from 12% at that time to 18%. Now, for those of you out there balking at a 3.5% interest rate, think historically where rates were. And at the time, 12% was actually considered a good rate. But at the time, rates went from 12% to 18%. And shortly after his tenure, Paul Volcker came in, and this is in the 1980s. And Paul Volcker wanted to take inflation down. He wanted to get it under control. And so he started to raise the Fed funds rate. He took it from 11% to 20%. And by doing that, inflation dropped from 14% to just below 5%. And at the same time, interest rates declined sharply, and they went from 18% back down to 12% where they were before. So Volcker raised the Fed funds rate, It controlled inflation. At the same time, interest rates dropped. But during that same time, something to keep in mind, I'm not a stock channel, I'm more of a real estate channel, but the stock market did drop by 30% at that time. And shortly after, we had a recession in 1982. So by raising the Fed funds rate, getting interest rates lower, the stock market did decline, right? Less capital out there in the market, and we saw a recession a couple years later. And now let's move into the 90s. This is Alan Greenspan's tenure, and we're moving into the late 90s, and where we saw inflation jump from 1.75 to 3.5%. So inflation doubled. Interest rates went from 7% to 8.5%. And Alan Greenspan was a student of the past. He did not want to, follow in Arthur Burns' footsteps and let inflation run hot. So what he decided to do was start to hike the Fed funds rate pretty much immediately, and he hiked it at the same rate of inflation, from 4.75% to 6.5%. And by doing this, inflation dropped from 3.5% to around 1%. And this caused a refi boom because interest rates also went from 8.5% to 5.5% during that time. So Greenspan also hiked the Fed funds rate by the same rate of inflation at that time. We saw interest rates decline, which gave us an opportunity for refis. Now the consequences were a little bit more dire this time. By hiking the Fed funds rate, and interest rates coming down, the S&P dropped by 50%. And we entered a recession in 2001. So 2 years later, we also entered a recession during that time, and the stock market declined significantly. Now let's talk about today. 2002, we have Jerome Powell running the Fed, and we've got inflation. It went from 1.75% to nearly 7% in just over a year. And we've had interest rates go from the lows of around 2.5% to upwards of 3.5%, which is where we sit today. Now, the Fed was pretty proactive during the 2020-2021 cycle, by purchasing mortgage bonds, mortgage-backed securities. That really helped keep interest rates low a lot longer than they probably should have been. But now the idea is that they're going to let these the tapering run off, if you will. It's going to end in March, at which point they should start, their raising of the Fed funds rate. Now, a lot of people believe that the Fed is going to raise, the Fed funds rates as early as March. Barry is one of those people that believes it's probably going to happen in May. He doesn't think they're going to hike the Fed funds rate and taper in the same month. He thinks that you have to end one before the other begins. He doesn't think they're going to do two things at one time. And so the first Fed meeting after they end tapering is in May. So his belief is that they're probably going to start to raise the Fed funds rate in May, at which point that's when, you should start to see interest rates decline a little bit. Now, he does believe that you're likely to see inflation continue and maybe even interest rates continue to move sideways to up over the next couple of weeks to months until they start to raise that Fed funds rate, at which point you're likely going to see a pullback in interest rates. Now, it could give those that have purchased early in the year an opportunity to refi. It's really hard to see what, plays out later in the year. But what we do know historically, if history repeats itself, which is what everyone says, every single time, the Fed has tried to control inflation, they've raised the Fed funds rate, which has brought inflation down. Interest rates have also declined during that period of time, and that's what we're likely to see this year. Now, the question is, where do they come down from? Are interest rates going to continue upwards of 3.75%? Are they going to touch as high as 4%? I don't believe you're going to see that. In one of my last videos, I said, the high side's probably 3.75. I still believe that based on the experts that I follow and read, but you're likely to see interest rates quite a bit higher than you did last year. So if you're someone that was considering purchasing last year, you got pre-approved, you were going through the process and you were basing your numbers off that, I would ask you to talk to your mortgage professional again and have them rerun the numbers just to make sure, you're still qualified for that amount, just to make sure you're still comfortable with that amount. Because the last thing you want to do is finally get into contract on a property and figure out that the interest rates have gone up, and then you're not in a position to move forward because the payment's higher than you thought, or maybe you don't qualify just because of where it puts your payment at that time. So If you're in that process, just make sure you're checking with your lender to have that conversation. Now, if you're one of those people out there and you need a lender, do me a favor. I'm putting a link below. I'll connect you with an expert out there that understands mortgage-backed securities, understands interest rates like I'm talking in this video, to help guide you in the right direction. Now, one thing to keep in mind when watching these videos is that these are all forecasts. They're all forecasts by experts. Nothing is in stone. I would ask you, if you're considering buying a house, just make sure you're comfortable with the payment, right? Don't worry so much about, the direction of the market per se, if you're comfortable with the payment, at least in my opinion. And don't also buy a house expecting that you're going to be able to refinance in a couple of months. Maybe that doesn't happen. What happens if you can't refinance? So again, being comfortable with the payment is key. Having some money in the bank is also key. Not stretching yourself is another, principle, if you will, when buying a house in this market. And have that longer term time horizon, like I've mentioned several times. Keep in mind, you don't know where the direction of the market is headed, but at the moment we have low supply, we have high buyer demand, and demand may taper a little bit if interest rates continue to rise a little bit. So you might have a better opportunity to get into the housing market. But again, don't buy a house if it's not the right time for you. Only buy if it matches, where you are in your life, the things that I've talked about in the past. But if you're watching this video and you're wondering, how higher rates affect monthly payments, whether you should, wait for lower rates, do me a favor, check out this video here. I dive into it in more detail. But for now, I appreciate you taking the time to watch. I appreciate all the support. Hope to see you again soon. Have a great day. Bye-bye.